So thank you all for joining in this webinar series on basics of international tax. Today we are having our last session, which is the 12th session, and we will be discussing the overview of multilateral instruments. So you would have heard about BEPS action plans, multilateral instrument, or in the short form, you would have heard MLI, that there is some impact on the tax treaties because of the implementation of MLI. So today we will be discussing those concepts, that what is MLI, what was BEPS action plan, what was the need for it, how MLI is implemented, what is the structure of MLI, right? And what is a covered tax agreement? Covered tax agreement is generally known as now CTA, just like we had read the term or we have heard the term of DTAAs. Now we also have another term called CTA. So CTA is nothing else other than DTAA, but it is a modified form of DTAA. Then what are the steps of application of MLI in terms of reading the provisions of changed DTAA, and then we'll go on to read a synthesized text. Synthesized text is that superimposed provisions of MLI which have come into force for a particular treaty, that how that is being superimposed, and a comprehensive text is being provided by the government of India. And we will read through one of the sample agreements so as to see what are the provisions which are undergoing some changes. So what we will also do is we'll not go into the detail of interpretation of the provisions of MLI, but we'll just look at the overview of the structure. And today we will try to wrap it up by 5:30 p.m. because we also have another follow-up session at 6 p.m. Which is, I think, organized by NIRC. So Piyush will give more details about that later on. So what was the need of BEPS? BEPS is base erosion profit shifting. That is how it was defined, how it was looked at by many countries. So there was a lot of globalization happening. There was a lot of advancement in technology which was happening, and which led to the traditional provisions of taxation to become irrelevant in terms of taxing rights which were given to source countries or the resident countries. And most of the time it was seen that the companies which were operating in a digital world, or which were having operations in virtual kind of form, they were not paying much of taxes either in the resident country or in the source country. They were incorporating countries in low tax jurisdictions and probably avoiding taxes. Then there was a public perception which had led to certain drawbacks in the terms of business of countries, and also in terms of the public policies of the government, wherein a company like Starbucks, it's a public case, right? It's a public knowledge in public domain. There were a lot of news on this particular tax planning, wherein Starbucks was operating a lot of stores in UK. It was earning huge revenues from that jurisdiction, but it came into public notice that Starbucks was not paying even 1% of the total revenues which they were earning from UK as taxes in this jurisdiction. So there was a lot of public anti-public sentiment, which made Starbucks to come up and voluntarily pay taxes, even though there was no legal liability in terms of paying taxes. They had planned their taxes so well that legally they were not required to pay taxes, but because of the public perception going against them and public boycotting their stores, they had to come up and pay certain taxes there. So the G20 group of developing or developed nations, or the major economies and the OECD members, they came together and said that how we should renovate the tax treaties in order to, or how we should rethink about the tax policies, which would not let these kind of companies to evade taxes in all the jurisdictions. It was meant to at least make these companies pay taxes in some one or the other jurisdiction. So that was the basic intent. It meant that there should be more transparency in MNC operations. You would have seen that most of the MNC operations have their sourcing companies in Cayman Islands or British Virgin Islands, or New Jersey's. So Jersey is also a tax haven, which is in Europe. New Jersey is in, I think, America. then Mauritius, all these jurisdictions were being used to exploit the tax laws in order to artificially avoid payment of taxes in various jurisdictions. So they were also saying, governments were seeing that more of the time a form is being created to overrule the substance in the underlying transactions. So how to overcome that? Then updating the international tax treaties and coherence in domestic tax rules affecting cross-border activities. So the older permanent establishment rules, say for example, it is more based on the physical presence test, as we have read in earlier sessions, that permanent establishment is focused on physical presence of a particular foreign entity into the jurisdiction of the source country. So now in the virtual world, when the technology is so advanced that you can do virtually business through websites and apps which are there on your mobiles, and you say for example Apple Music, there is no requirement of Apple to come into India, although they are present in India through subsidiaries. But for the music they are selling, or for the content which are they are selling on their mobile phones through the apps, there is no need for them to come into India and have a physical office. And whereas Indian government feels that because this source of revenue is there in India, even though there is no permanent establishment, there should be some mechanisms as to tax these kind of companies. So that was one of the reasons. Then there was need for certainty in businesses, for certainty for businesses as well as for governments. Now you would have seen that we have been struggling with the litigation on aspect of royalties, fee for technical services. The foreign companies say that we are not going to be taxed in India because the traditional definitions of royalties or fee for technical services as defined in the treaties are not covering the services which we are providing. But the source countries, majorly the developing countries, have been staking claim, and they have been disagreeing with the traditional definitions of royalties and fee for technical services. So therefore, the countries of OECD as well as many non-OECD countries, say for example India is a non-OECD country, but India has played a very, very significant role in the drafting of BEPS section plans and multilateral instrument also. They have provided a lot of inputs, and it has played an active part. So then there is a change in tax landscape. As I mentioned, that the ways of doing businesses are changing, and therefore the ways of taxation should also change. And therefore there are certain provisions which have been unilaterally imposed in the domestic tax laws of various countries, including India. Say for example, equalization levy. It is a unilateral tax. There is no requirement of changing the double taxation avoidance agreement. There's country by country reporting, which has been implemented in the Indian Income Tax Act, that multinational companies, they have to file certain reporting about their group structure, about their employees, about where they are earning revenues from. So there is a transfer pricing reports which need to be filed with the income tax authorities. Then there is a new section which is 94B, which restricts the deduction of interest payment on loans paid to either the associated enterprise or loans paid to a foreign entity guaranteed by an associated enterprise. So all these mechanisms of taxation have come out from BEPS section plans only, but some of the plans were requiring multilateral instrument, wherein the two countries need to sit together and then renegotiate the treaties, whereas certain provisions were allowed to be implemented unilaterally by the jurisdiction or by the countries. So that is how it has evolved, and BEPS section plan has been going on for last 8-9 years. So the first, I think, BEPS section plan report was presented in 2014 somewhere, and then final report was presented in 2015. So then MLI means multilateral instrument, has been developed as a mechanism to implement BEPS measures in a synchronized and efficient manner, and it obviates the need to bilaterally renegotiate 1,000+ DTAAs across the globe. In fact, the number I have written is 1,000+, but some people say that it is even more than 3,000 treaties. See, because permutation and combination, there are around 200 countries, and if each one is going to enter into agreement with each other, the tax treaty network across the globe is huge, and around 100+ jurisdictions have come together to renegotiate this MLI, to draft this multilateral instrument, and how this is going to be implemented in terms of bilateral treaties, we'll see how it is interpreted. Now let's come to the basic overview of what was the BEPS section plans, what were the BEPS section plans, and what were the areas which were targeted under these plans. So the first action plan was digital economy. As I mentioned, that digital economy means your Apple kind of companies, or Adobe, which was providing your softwares through a remote location, through online downloads, not having a permanent establishment in India, and they were always claiming that these kind of services do not form part of, are not covered under the definition of royalty, neither in the definition of fee for technical services. So therefore, there should not be any kind of taxation in the source country. And within this action plan, it was recommended by the OECD that jurisdictions can unilaterally impose certain taxation in their own jurisdiction, so as to bring these digital transactions to tax. And equalization levy was one of the propositions which was proposed. So on a similar line, UK has also imposed certain taxes on the basis of gross basis taxation, which is not covered by the treaty. So you would have heard of equalization levy, that there is a now very enhanced scope under the definition of scope covered under equalization levy, and it has been enhanced by Finance Act 2020. We have a separate session which I had taken earlier. I'll share a link with you in the WhatsApp group. So I have also provided the links of the final reports which were presented in 2015 on each of these action plans. So if you would click, when I'll provide you this presentation, when you will click, it will take you to the OECD page, which provides with the final reports which were presented in 2015. So it may be possible that these final reports were amended, or there were subsequent actions which had taken place, but these are more comprehensive set of documents which can provide you a brief overview of what it all means. Then the second action plan was related to hybrids. Hybrid mismatch or hybrid instrument is certain instrument wherein in the source jurisdiction the treatment of income is something else, whereas in the country of residence the treatment is something else. Say for example, there is a compulsorily convertible debentures which have been issued by an Indian company to a company resident in Luxembourg. Now, for Indian tax purposes, when you are paying interest to the convertible debentures, even though they are compulsory convertible debentures, till the time they have not been converted, for Indian company, the interest payment will be treated as a deductible expenditure in the hands of Indian company. Whereas while you go to Luxembourg, in their own domestic tax laws, and in many European countries domestic tax laws, it happens that such kind of compulsorily convertible debenture kind of instruments are treated as equity instruments itself in their local laws. So what it happens is that here from India the money goes as an interest payment, but from the local law perspective of the of that country where the company is resident, the income is treated as dividend income, and this dividend income is generally not taxable in these jurisdictions wherever the countries are holding the investment from. So this is how the planning used to happen, that for India, even though you will be taking benefit of treaty, and most of the times you will be paying taxes at the rate of, say for example, 10% or maximum 15%, whereas the Indian company will get a deduction and which will result into tax deduction of 30%, because Indian tax rate is 30%. So there used to be a saving, net saving, even though in Luxembourg they will not be paying any tax. So that was these were the kind of hybrid mechanisms which were eroding the tax bases in the source countries, as well as not making the home country entitled to certain tax revenues. So action plan 2 addresses these kind of instruments, and there has been a comprehensive review of such kind of instruments by OECD under various jurisdictions, and they have constituted peer review groups also which will review. And even though many times certain countries want to protect these kind of instruments because these are the mainstay of their economy, because these kind of instruments are exempt from tax in those jurisdictions, many companies set up intermediary holding companies in those jurisdictions, and therefore they are kind of boosting these small economies. So these kind of hybrid instruments have been taken care, and they provide mechanisms as to how to handle these situations. Then action plan 3 talks about controlled financial corporations. Now yeah, Piyush.
If we click on this action plans, so it will take us to that link also.
Yeah. See this link. So it will take you to OECD website.
Okay.
Which has this hybrid, which has got the final report on hybrid. So this, say for example, this link is hybrid mismatch, right? Now if you see this link, this is controlled financial corporation.
Great. This is
right?
very
Digital economy means you have digital economy link.
good.
And for overall, if you want to go to overall web section plans, this is the link for overall, means you will find everything here, right?
Great. Yes.
So controlled financial corporation companies is not a concept which is followed in India, but it is a very common concept in Western world, majorly in America, and I think in Japan also. There are, what this concept means is that if you have a company which is located outside your country, but it is controlled by the company which is based in the resident country, and the CFC, the controlled foreign company, is earning certain kinds of passive incomes. Passive incomes are generally considered as interest income, royalty income, or wherein you are trading between your associated enterprises only. Means you are purchasing from associated enterprises and selling to associated enterprise, and you are not dealing in any independent business activity. So in those cases, what those countries' law provide is that the income of these CFC companies will be deemed to be the income of parent company itself.
So
So
holding
these
and
are,
subsidiary.
yes.
Okay.
So this is not a concept which is in India. You will find a similar kind of concept, which is the POEM concept, which is the place of effective management, where the foreign company itself is treated to be the resident of India. So in a way, you are bringing the income to tax in India, but controlled financial corporation means that the income of that CFC will be considered to be the income of the parent company itself and merged into that. So then there is more elaborate measures as to how to control these CFCs, and even many times in the local laws there is not just immediate subsidiaries but even step down subsidiaries which are covered within the provisions of these laws. So action plan 4, coming to action plan 4, it talks about interest deductions. As we have mentioned that there were a lot of tax planning happening around interest deduction, that parent companies will give huge loans to the subsidiary companies and extract the profits in terms of interest payments itself rather than distributing dividends. How it used to impact the tax provisions is that in the in the source country, the company paying the interest income will get 100% deduction and will claim the tax benefit on the 100% of interest payment, whereas the company receiving the interest payment will be taxable only at a limited rate as per the Double Taxation Avoidance Agreement. So therefore, in order to limit these kind of interest deductions and tax planning around interest deduction, there were certain recommendations which were proposed, and out of these recommendations only, India has picked up one of the recommendation wherein it has introduced section 94B, and you would be aware that 30%, if the interest payment exceeds 30% of the EBITDA which is earned by the company, then that excess amount is not to be allowed, and the interest which is defined is interest payable to either associated enterprise, which is foreign associated enterprise, or to another foreign entity wherein the loan is guaranteed by the associated enterprise only. So in these recommendations, there are even higher limits. India has restricted to the minimum limit, which was prescribed as 30%. And in fact, the action plan also recommends in certain cases the limit of deduction to be lower, in the terms of that it can be 30%, it can be 10%. Even if it exceeds 10% of your EBITDA, the disallowance can be made. So this was action plan 4. Now action plan 5, harmful tax practices. So what is harmful tax practices? In certain countries, there is a concept of private rulings. Private rulings is something which is not as a advanced tax ruling, but it is a private ruling wherein a company can go to the government or the tax authorities and negotiate a tax rate on the basis of their own, for their own company. So it is not as per the law which is available to all, but because of certain provisions or certain investment which are they are making, they can negotiate a tax rate for themselves, which will not be known to anybody else. So these are kind of harmful tax practices which were being, implemented by jurisdictions, by the sovereign countries itself. And there were peer groups which were set in between the collaborating members, wherein they reviewed the tax practices of each and every country. And even Indian tax holidays, say for example 80IA, 10AA, and these kind of provisions were reviewed by other countries. And I think in one or mostly all the tax benefit provisions of India were okayed by the peer groups, by saying that these are fiscal benefits rather than harmful tax practices. So that is what my understanding says, but these documents, to my mind, I'm not very sure whether they are in public domains or not. So then we come on to action plan 6. It is prevent treaty abuse. So treaty abuse, if you would have seen in you would have referred to the discussion on permanent establishment when we were discussing construction P, building site P, or supervisory P. Then we had discussed a concept wherein 2 or 3 companies of a group will come into consortium. They will form a consortium and they will say that, okay, one company A will only do survey, company will only do digging or land erection, something of that sort, and company 3 will come and finally erect the machine for the project. So in a way, none of these 3 companies will be meeting the threshold of, say for example, 180 days as may be prescribed in the treaty for constituting a construction P in that source country. Now this was artificially preventing the establishment of PE. So this is one of the kind of treaty abuse which used to happen. Then the other treaty abuse was dependent agent PE, that everything will be done by the dependent agent. They will secure the contract, they will finalize the terms and of the contract, they will identify the customer, they will also say agree on the payment terms and delivery terms, but they will finally not sign the contract. And it was one of the major contentions of the taxpayer that because the Indian agent is not signing the contract, therefore they cannot be considered as concluding the contract. So this was seen as artificially avoiding the taxation just by utilizing or using the terminologies used in the treaty. So these are some kinds of treaty abuses which were happening, and therefore they came up with action plan 6, which dealt with all these kind of areas and recommended that what can be done in order to negate the such kind of treaty abuse. And if you would remember that in construction P, we had read that even if closely associated enterprises or associated enterprise of within one group which are controlled by same entity, they enter into different contracts which are related to each other, and then at that point of time the consolidated time period will be considered to be considered for the period of establishing permanent establishment. Similarly, dependent agent, you would have seen that if the dependent agent was working for multiple entities of a group, then they would say that this is not wholly dependent on one entity, and because it is not wholly dependent on one entity, it will be considered as independent agent, and therefore dependent agent provisions will not apply. Now in this action plan, it was recommended that the treaty provisions can be changed to say that if the agent in source country is acting only for related parties of one group, associated enterprises of one group, even though they are multiple number of entities, we will be considering that they are working for only one party, and then the agent will be treated as a PE of each of the foreign associated enterprise for whom they are working in the source country. So these are the some of the kind of provisions which have been recommended and also now implemented in some treaties. So we will read through that. Then there were permanent establishment status. We have already discussed. So prevention of treaty abuse and permanent establishment somewhere linked, and they are somewhere overlapping also. Yeah, Piyush.
Himanshu is asking that can you please explain CFC again?
CFC is controlled financial corporation, which means corporation or company, which means that if this is most commonly found in the laws of US and it is not found in Indian laws. So this is first per se not relevant for the Indian laws, but for an understanding perspective, I will just explain that if a US company is having a subsidiary company, even if it is a direct subsidiary or even if it is an indirect step down subsidiary, and if that subsidiary company is only earning passive incomes are generally defined, it can be different according to different laws. Passive incomes are generally defined to mean interest incomes, royalty incomes, or brand royalties, or where you are just doing business transactions with your associated enterprises. Now in those dealings, it can be either both ways, that you are purchasing as well as selling to the associated enterprise, or it can be only one side only, that it might, the local laws might say that if you are only purchasing from the 100% of your purchases are from associated enterprise, will consider you controlled financial company, or if 100% of sales or more than 90% of your sales are to associated enterprise, will consider you to be controlled foreign company. Also, controlled foreign company has certain control defined, that how control will be considered in the particular situation, that whether the board of directors are controlled by a company in US, or whether your shareholding, the voting interest is controlled by you. So there are certain thresholds which are prescribed. Now once you are defined as a controlled financial company, then what happens is that entire income of the CFC becomes the income of the parent company. It is merged in the income of the parent company, even though if it is not distributed, even though the CFC company is not making any payment of interest to the parent company or royalty or dividend to the parent company, CFC's income will be considered to be income of parent company and taxed accordingly in the local laws of the parent company itself. So this is the concept of CFC. So this is broad overview, but there are different parameters in different laws, right?
Anshul, it means all subsidiary income will be clubbed to the parent company income?
Yes.
Oh,
Which
okay.
for only for those subsidiaries which qualify as controlled foreign company.
Okay, so qualified subsidiary income will be clubbed, even though they are not the parent company residence. It will be different country
Yes.
subsidiaries established in different countries.
Yes. Yes. Yes.
Okay, thanks.
That is
Thanks
what
for
is mean
clarification.
controlled foreign company. So, right. So moving on to action plan 8 and 10, 8 to 10, in fact, it is related to various transfer pricing laws. It includes action plan 8 is on intangibles, action plan 9 is on risks and capitals, means where the allocation of risks and capitals are happening. And then action plan 10 deals with high risk transactions. So it was also considered that the present, present way mechanism of functions, assets and risk is somewhere not meeting the transfer pricing requirements in the current scenario, in the current way the business are being managed or done, and therefore they have come up with new recommendations on the transfer pricing. Then action plan 11 is basically how to collate data and how to analyze those data which has been collected through BEPS action plans. Then action plan 12, it's also a very important action plan wherein mandatory disclosure rules have been provided. Means it says that if a company is entering into an aggressive tax planning, then they will have to voluntarily disclose it to the tax authorities. Now this is something which has not been implemented and it has been left to be implemented by the local jurisdictions, but somewhere I have heard that in some of the countries these provisions have already been implemented. That means that say for example in your tax audit you will be required to disclose. Hello.
Yeah.
Does someone want to say something?
I think A. Raja Gopalan wants to ask something. Okay, continue, Anshul.
No, I didn't. No, I didn't. I didn't ask. I didn't.
Okay. Okay. So, in say for example, in your tax audit report, you are asked to disclose whatever aggressive tax planning has been done by the company. So you will be required to disclose all the tax planning and see If you disclose those tax planning, what will be the reaction of tax authorities? So these are kind of mandatory disclosure rules on which some recommendations have been made in this action plan. Then action plan 13 talks about country by country reporting, which we have all seen now in the multinational companies and multinational groups. The Indian constituent entities are required to make certain reportings to the Indian company, whereas the Indian head office companies, the Indian parent companies, say for example, I can talk about ONGC, which is one of the big multinational corporations, or ONGC Videsh, which is a subsidiary of ONGC, but ultimately it's ONGC. So they might be required to file master file documentation with the Indian jurisdiction. So say for example, other Indian groups which are also having their subsidiaries outside of India, now they are headquartered in India, so they will file master files with Indian jurisdiction, whereas their foreign subsidiaries will file certain local files and constituent reports with their local jurisdiction in the foreign countries. Similarly, the foreign multinational companies having subsidiaries in India, the Indian subsidiaries will file certain limited information in the prescribed forms and formats to the Indian tax authorities as well. And there are elaborate recommendations also which have been made in terms of exchange of information regarding country by country reporting, and then how to maintain confidentiality of these information, because in country by country reporting, a lot of group structures where the procurement is happening, where the sales is happening, the entire your supply chain is kind of exposed to the tax authorities. So therefore it is very important to maintain confidentiality about these reports, and this is what action plan 13 talks about. Then action plan 14 talks about mutual agreement procedure. There is and I will also mention that action 5, action 6, action 13 and action 14 are minimum standards, that once the multilateral instrument comes into implementation, comes into force, these are the minimum standard which must be there in multilateral instrument. And whatever agreements are, whatever DTAAs are getting changed, there has to be these standards which must be changed according to the provisions of multilateral instrument. So now what multilateral mutual agreement procedure says is that this it has always been there in Indian treaties and most of the treaties around the world. What it talks about is that wherever there are tax disputes which are arising in a country, the resident country can invoke mutual agreement procedure in their home country, wherein the home country tax authorities will sit together with the tax authorities of source country, and they will discuss and negotiate the tax positions, and they will negotiate the tax positions on the behalf of taxpayers. So in most of the times, taxpayers do not form part of the conversation, but they are just only providing information to the tax authorities, and whatever tax authorities then decide is treated to be final tax position for the particular country, particular assessee for that particular year. Now, if you would remember in the permanent establishment discussion which we were having, we had discussed a case of e-funds. In e-funds, it was mentioned at the tribunal level, and it was an argument taken by the taxpayer that whatever conclusions are drawn by mutual agreement procedures, these are not legal findings. These are only negotiated agreements, and therefore they cannot, the findings of the mutual agreement procedures cannot be implemented to subsequent years. And in the tribunal judgment, the argument was kind of accepted, although there was no final word on this particular aspect, but they had modified the way the computation of income was made as compared to what was the computation mechanism as prescribed in the mutual agreement procedure, the order of MAP in the case of that company. So in a way, the tribunal accepted that yes, the conclusion drawn through an agreement which is a part of mutual agreement procedure is not a legal document. So this is action plan 14. Then action plan 15 talks about the multilateral instrument itself, the administration of multilateral instrument, that how it will come into force, how the countries need to sign it, and how they need to ratify it, and well it will come into force. So it is only the administrative action plan which talks about multilateral instrument.
Anshul?
Yes, Piyush.
Alok is asking that are APA, BAPAs a consequence of basic erosion?
No,
EP,
BAPA, so I'm not very sure about what is BAPA, but APA is not a result of BEPS action plan.
action
APA
plan का
has
ये
always been there.
है इसका
Sorry?
BEPS का ये APA BAPA है?
नहीं है सर, नहीं है. देखो BAPA तो I don't even know what is BAPA. I think
BAPA is bilateral APA.
Oh, so BAPA is APA only.
Yes, sorry.
So APA is not a consequence of BEPS. It has always been there in the treaties. Even in fact, it is unilateral implementation in these countries. So, for example, India has implemented an APA program through its tax laws, domestic tax laws. So it is something which is not at all coming out of BEPS.
What is the full form of BAPA? BEPS.
Bilateral APA.
Bilateral APA.
So see, I can just give you a short 1 minute background of APA. That, say for example, if I am an Indian company of a multinational group, right, and I am subjected to transfer pricing in India, what I fear is that transfer pricing authorities are making irrelevant and unnecessary additions to my transfer pricing time and time again, and each year I have to go through that pain of transfer pricing assessment. So Indian income tax authorities has introduced a concept of APA, which is advanced pricing arrangement. So transfer pricing is all about pricing, right? How you price your transactions. So what they do is that we go and negotiate with the income tax authorities that this is the amount of price for the transactions which we will undertake. Say for example, if we are into cost plus entity, we are a offshore outsourcing entity, and we are earning a cost plus margin of, say for example, 12% year on year, whereas income tax authorities in the assessment are making an addition saying that you must have earned 20%. So now we go and agree, we negotiate the pricing with the tax authorities and say that my type of business should only be remunerated at, say for example, 14%. So I'll leave 2%. The income tax authorities will come down to no, it has to be at least 18%. So it will be finally, say for example, negotiated at 17%. Now this APA is only limited to that company and not applicable to anybody else. It is not like advanced rulings or authority for advanced ruling or a court judgment that okay, we can go and argue that now income tax authority, you have agreed for a 17% price or 17% margin for company A, so that should automatically apply to me also. No, it is always an agreement, a negotiated agreement between the tax authorities and the taxpayers. Now bilateral APA comes into picture where the, say for example, my parent company who is giving me that margin is based in Japan. Now Japan also comes into picture. The Japan tax authorities also come into picture and say that we will negotiate the tax agreement with the Indian company, because ultimately what happens is that if Japan is making a higher payment of margin, say for example, instead of 12%, they are now obliged to pay 17%. Japan tax authorities might say in terms of an unilateral agreement that you are paying higher arm's length margin, which I will not allow. In Japan, say for example, while claiming the deduction of the expense, the Japanese tax authorities can say that you were paying 12% earlier, now you have suddenly increased it to 17%. I will not allow this 5%. So now what happens in bilateral agreements, that these two countries as well as the taxpayer of India and Japan will combinedly enter into an agreement, and they will say for example, let's say agree on 15%. Now for 15%, neither the Indian tax authorities will challenge, nor the Japanese tax authorities will challenge. So this is called bilateral APA. So bilateral APAs and unilateral APAs, these are not consequence of BEPS action plan. They were already there and it was introduced long back.
But even in AAR also there have been revisions in the rulings. For example, treating a contract as a supply contract, which was later on questioned as it is a comprehensive contract because it's a design, manufacture, supply, and all the activities are there. So accordingly, the tax treatment was spelled differently. In one
So
of the
that is only an interpretation issue because different benches or different judges in
Uh,
AR may interpret the law differently.
yeah, but actually the essence of the contracts was similar. I mean, there was no change in the basis of the.
Yeah, that can always happen with judiciary. They can interpret the same thing. We have read so many cases with contrary judgments on the same aspects.
Yeah.
So that is only the interpretation issue, that how a particular judge or a particular bench is reading that law. That is only that thing. But BEPS is a broader aspect that the countries have come together. They have agreed that yes, this was read as this, but now we need to change it.
Okay. Got
Right.
it. Okay, thank you.
So coming on to the overview of MLI, what it says is that it is an outcome of Action Plan 15, as we have already discussed. MLI means multilateral instruments. Say, for example, there is a draft text of a treaty which says that this provision can be modified in this way, this can be modified in this way, this can be modified in this way. There are many articles of multilateral instrument itself which provides various provisions to be modified. Now I, as an Indian government, can come up and say that I have entered into treaties with 95 countries. Now I notify 93 countries to be covered under the multilateral provision. And I will also notify that provision A I want to implement against, say for example, UK, Singapore, China, Mauritius, and this country. Now this is how I will make my recommendation. Similarly, the foreign countries will also say that okay, we also cover India as our treaty, which will be covered by the provisions of MLI, and they also choose certain options 1, 2, 3, 4, 5, 6 against me. Now many times there are certain provisions that for some provisions a one-to-one match is required, right? That I have also chosen and foreign country has also chosen the same provision, only then it will apply. In some of the provisions which we discussed about minimum standards, which were related to preamble and and a few other things, those minimum standard neither I can choose, neither the foreign country can choose. They will automatically be applicable until and unless that there are certain circumstances where my treaty already has that kind of provision. So we'll come to that. Now MLI came into force. The MLI was published and MLI was signed by all the countries on 1st of July 2018. But by just signing, it means that countries have agreed to implement MLI, but it does not still mean that it has been implemented. Why I am saying so? Because the one-to-one match of country by country needs to be made before a particular DTAA can be, changed. Now, what it prevents is, what it helps is that I need not go and renegotiate the treaty with 95 countries or 93 countries, which I have treated as covered tax agreements. I am just providing my comments on this multilateral instrument. And if the foreign country also provides those comments and there is a matching, then it will automatically apply. There is no need to renegotiate or get into detailed discussions and re-notification and everything like that. So till September 2020, 94 countries or jurisdictions have signed MLI, and 54 of these countries have also deposited their instruments of ratification. Instrument of ratification means first step was signing that okay, we want to be covered by MLI. Instrument of ratification is each and every provision they have highlighted that against which country we want to apply which provision of the MLI. So that is what is called ratification, instrument of ratification. And for more details about this particular, which countries are covered, which countries have signed, which countries have already submitted the instrument of ratification, you can go to this link and then you will find more details on this particular aspect. Then as I said that multilateral instrument does not apply automatically. Just by signing the multilateral instrument, it does not mean that it has applied. We need to notify the treaty, which will be treated as covered tax agreements. So now there was a concept of DTAA. Then out of all those DTAAs, there will be some DTAAs which will now be considered as covered tax agreement, means which treaties have undergone some change because of the implementation of MLI. So that we need to search. I am having a list of all those countries which are now MLI covered tax agreements. CTAs are required to meet certain prescribed minimum standards. As I mentioned, preambles and a few other provisions are minimum standards, whereas certain other substantive provisions, say for example, how to prevent treaty abuse, how to define dependent agent, there are options given in the multilateral instrument itself. So you can you have to notify that what provision I want to apply against another country, and if other country is also applying the same provision against me, then it will match, and then we will say that this provision now has undergone a change. So as it mentioned, MLI is a flexible instrument. Provisions will apply according to jurisdiction, policy, preferences through notifications, section of options, and placing reserving. Reserving means I can also say that I am reserving this option. So say for example, for prevention of treaty abuse, they have provided 3 options, that either you can keep this text in the treaty, or text B in the treaty, or text C in the treaty. So what options I need to opt for, or I can also say that I will not choose these 2 provisions, I am reserving out. So that is also possible. Now, optional provisions which usually apply when both parties have selected for an option, for both parties have selected the same option among alternatives. So that's what I'm saying, that if both the countries have chosen the same option, only then it will apply. And there is some exception, say for example, Article 5. Now, when we are talking about Article 5, we are not talking about Article 5 of the DTAA, which is related to permanent establishment. These articles are the articles of multilateral instrument, right? So there are now different articles. So we need to read articles of DTAA and articles of multilateral instrument. Further, if a party does not want to apply a certain provision, it may reserve such provision. We have discussed this. MLI contains compatibility clauses that define relationship between MLI. So for example, whether it will supersede the provision. Compatibility clauses means that there are provisions written that this provision will supersede the provisions, existing provisions of the DTAA, or it may refer that it will replace the provisions, or it may say that it will amend the provisions. So these are few terms and concepts which are mentioned in MLI, and you will have to read the language of each provision wherein it has been mentioned.
Sir, this MLI is only the existing bilateral agreements which can only be included in this, or any treaties which is not signed also can come into this MLI, sir?
No, sir. It can only be the existing DTAAs.
Okay.
Because if you are entering into a new treaty, most likely you will always have the new provisions coming into force, which means you will always, incorporate the new provisions into the treaty itself.
Automatically. Okay.
Right. So this is only to safeguard the renegotiation of already existing treaties, because OECD, or means the member countries, believe that whenever you are entering into a new treaty, if you want to implement those provisions, you will always have them in the new treaty, right? There will be no cause that you don't want to incorporate them. And if you don't want to incorporate, then that is your personal independent choice. That means you didn't want to implement these provisions. Right.
Thank you.
So now what is the structure of MLI? So MLI consists of 39 articles. So we have read only 27 or 28 articles in DTAA, but MLI, which seeks to modify the treaty, it covers more articles than the existing model conventions. So Article 1 and 2 set out the scope of MLI and the interpretation of terms used therein, means basically definitions and everything. Then Article 3 to 17 deals with the BEPS tax treaty measures, means whatever changes can be made in the provisions of DTAA, those are mentioned in Article 3 to 17. Then Article 18 to 26 cover provisions related to mandatory binding arbitration, that how arbitration can be done. And India has always taken a consistent position that arbitration cannot be done in tax matters which are concerned with the sovereign rights of a country. So arbitration can only be done, as per India's stated position, only for commercial agreements and not for the tax purposes. And that's why Indian government is also trying to challenge the bilateral arbitration, which has granted certain benefits to Vodafone in a recent ruling. So Article 18 to 26 deal with these provisions, that what are the binding arbitration provisions. Then Article 27 to 39 contain various administrative provisions related to adoption and implementation of MLI, including ratification and entry into force, that what are the dates to be seen, when you need to implement it, which provisions are to be implemented from which date. So Article 27 to 39 deals with those provisions. So now we have a separate set of 39 articles, but from an income standpoint, the relevant articles are 3 to 17, which are majorly changing or have the impact of changing the provisions of DTAA. Now there are explanatory statement which has been provided by OECD, which amplifies the understanding of MLI. Then OECD website has also, there is a website also which provides all the lists of various provisions which have been, listed by each of the country in their ratification instrument towards each of the other countries. So they've also provided a tool wherein you can just click India, Canada, and there will be, list of changed provisions which will come up. So I've not been able to trace that link very easily as of now, but I'll try to find that link. But brief, all the overview of multilateral convention to implement these tax treaties and which countries have signed it, you can find on this link, which I have provided here on the slide. Now, as regards to the structure of MLI, it talks about minimum standards. As I mentioned, that minimum Articles 6 and 7, they reflect the minimum standard for prevention of treaty abuse under BEPS Action Plan 6, right? Then Article 16 reflects the minimum standard for improvement of dispute resolution under Article 14, which was related to MAP. So these are minimum standards and these must be incorporated in the multilateral instrument, and there is no option to choose out. Only option is that you the bilateral agreement or the bilateral treaty already has these provisions which are satisfying the intent as provided in Article 6, 7 or 16. And then there are optional changes to the tax treaties in MLI, which includes means these are optional things that either of the parties can notify them, and there is no need to one-on-one matching between the two countries. And therefore, if I have notified it, it will apply for my residents, and if other country has notified it, it will apply for their residents. And it is not necessary that one-on-one matching needs to be done so as to change the treaty. And when we talk about Article 3, Article 5, Article 8 and Article 12, these are articles of the MLI and not the tax treaty. Now Article 3 deals with transparent entities, tiebreaker of dual resident entities, different options for elimination of double taxation, which we have read in earlier sessions, minimum shareholding periods to benefit from the provisions of provisions related to dividend. We have read in dividend that for a particular period of time, the company must be holding the shares before the distribution of dividend, only then. Or we had also discussed that whether it is before dividend distribution or whether it can be after dividend distribution also. So these articles deal with that. Then changes to the definition of permanent establishment under Article 12. For such MLI provisions, there is generally flexibility to opt out of either all or part of the provisions. Now, how to apply them? Means this is a table wherein you can see that how to apply vis-a-vis country A. So say for example, country A is India. Now MLI provisions that form part of agreed minimum standards, that is Article 6, which is purpose of the CTA or covered tax agreement. We have now defined that what is the purpose. Now the purpose, we will come to one of the purpose in the sample covered tax agreement, and it talks about that purpose is also to not allow double non-taxation. It has never been one of the purposes of the treaty. It was always to provide benefit from double taxation, but now the purpose also says that it is to avoid double taxation but also to prevent from double non-taxation. Then prevention of treaty abuse, Article 16, mutual agreement procedure. Opting out of such is possible only in limited situations. Means this will apply to all CTAs, whichever country has said that you are my covered tax agreement, and the other country has also said that I am a covered tax agreement. So first of all, we must also understand that what is covered tax agreement. Say for example, I have listed, means India for example has listed 93 out of 95 treaties which it had already entered as its wish list to get covered under the multilateral instrument. But say for example, out of those 93 countries, only 60 countries have opted that yes, they also want India in corresponding manner to be a covered tax agreement. And then once this one-to-one matching about the willingness to change the provisions of the treaty is there, only then it will become covered tax agreement. Then there is a second step when we come to see that which provisions are to be implemented in this covered tax agreement. So the first step is to see whether there is a covered tax agreement or not. Say for example, Mauritius, China, US, they have not covered India as their tax agreement. In fact, US has not even signed the MLI. They are out of the MLI instrument altogether. So, and for Mauritius, China, they have not considered India as a covered tax agreement. So even though India mentioned Mauritius and China to be covered under MLI through its notification, but because these two countries have not retrospectively covered India as a covered tax agreement, therefore India, Mauritius, India, China treaty do not become covered tax agreement, right? So now once the covered tax agreement is there, after that we are looking at these provisions, that which article of MLI becomes applicable and which does not. Then moving on to the second point, MLI provisions that would apply to a CTA only when both the CTA parties have made notifications to this effect. Means a one-to-one matching of the provisions need to be there, only then the provision will become effective, right? Then the third point comes, MLI provisions that would apply to CTA unless reservation is made by either of the parties. Means you do not need to notify these provisions. These are kind of automatic one, but you have option to reserve out. Means you can say that I don't want these provisions to be implemented in my treaty. Then these can be said to be optionally not implementable. Means first step there is automatic implementation for third point, but you can opt out of it. That what it says, that to apply to CTA of country A unless reservation is made either by country A or other party, it will automatically apply. Even when the CTA parties have neither made a notification nor made any reservation, the provisions would still apply to CTA, right? Moving on, India filed its ratification instrument on 25th June 2019 with OECD, and therefore for India, means for the purposes of Indian tax agreements, that is a very relevant date. India has covered many countries, and out of these covered countries, 28 countries have retrospectively, means reciprocatively, also submitted their ratification instrument covering India as a covered tax agreement, and they have submitted the agreements at various dates. So therefore these are the 28 countries on whom MLI is applicable. Now the entry into effect has two provisions in the treaty, which says that for withholding tax provision, immediately after the end of the immediately after the date of submission of the ratification instrument, either January 1, which is the calendar year, or the first financial year, the date of first next immediately succeeding financial year or tax year for a country, that will be considered to be the effective date for withholding tax provisions. Whereas for all other taxes, the period will begin only after the expiry of 6 calendar months following the latest date on which MLI enters into force for each of the party to CTA. Say for example, India has submitted its ratification instrument on 25th of June, but Canada, say I have mark plus mark, MLI entered into effect from 1st of April 2020 for withholding tax, but from 1st of April for other taxes. Means that these countries have submitted their ratification instrument on a date so as to not complete the 6 months period before 1st of April 2021, 2020, which has already gone by. So 6 months period was not getting completed on 2020. So therefore, for all other taxes, the provision will get implemented from 1st of April 2021 and not for 2020. Now there is a controversy which is going on, that what is the difference between withholding tax provisions and other taxes. And some of the consultants are of the view that for India, withholding tax provisions does not matter, because multilateral instrument is not changing the withholding tax provisions for India, because India already has 195 section in their domestic tax law, which is kind of governing the withholding tax provision. And as such, multilateral instrument has also not changed any of the tax rates which are implemented in the treaties. So therefore, many of the consultants are saying that withholding tax provisions are per se not impacted. As they were in force, they will keep in force. However, if there is a substantive change in the provision of, say for example, permanent establishment, or you need to consider certain provision in the treaty so as to see whether the income becomes taxable or not, if those provisions come into effect from 1st of April 2021, then the withholding tax cannot be enhanced to cater to those increased definitions from 2020 itself. So whereas some of the consultants are also saying that no, because withholding tax provisions apply, so we'll have to see entire provision and we'll have to implement the MLI as a whole from 1st of April 2020 only. So now this is a controversial point. There is no final word on this. Where consultants are taking their positions, and you and I will also take our positions as we go along reading this. So as I mentioned, India-USA treaty is not impacted because USA has not itself signed the MLI, and India tax treaty with China, Germany, Switzerland, Mauritius, these are some of the examples which are not affected because these countries have not ratified, means these countries have not notified India as their covered tax agreement. So in fact, India and China had recently agreed into a new treaty on November 2018 itself. So therefore, China did not consider it to be a valid point to re-amend the treaty with multilateral instruments. Similarly, with the Mauritius also, we had changed treaty with effect from 1st of April 2017, and therefore Mauritius also did not want to change the provisions of its tax treaty with India. Now there are two other countries, Cyprus and Saudi Arabia, who have also notified the tax treaty, but their documents were submitted so as to make the treaty effective for withholding tax purposes as well as for other tax purposes from 1st of April 2021. Right?
Yes, Anshul, right.
Any query? I think there was one chat box which was mentioned. Minimum standard in clause 6. Minimum standard is a principal purpose test. We'll come to that. Right. So these are the steps for application of MLI. Entry into force means which date it has been entered into force. Verify if MLI has entered into force. And I think MLI was signed by all the countries in July 18. So MLI has come into force.
Anshul, Giri Kumar is asking, we have to refer MLI going forward for these 28 countries.
Absolutely, absolutely, sir. You cannot read the DTAAs now in isolation.
Okay.
Right. So today we are dealing with just an overview, and I have heard that BCAG, with Bombay Chartered Accountants Association, I think they have held a full-fledged series on MLI provisions. So MLI in itself is a big topic. So today we are just giving you an overview of how it is structured.
MLI.
Sorry.
Can we start next session on MLI?
We'll do that, sir. But as of now, probably we'll need to go past our return season also, because it's quite hectic,
exactly,
and tax audits and transfer pricing, everything is there.
Yes,
So
yes.
probably now we'll come to see probably in December or January when we
Yeah,
are a
we'll
little
see
bit
the feasibility,
relaxed,
feasibility.
right? So then the verify that MLI has entered into force. Then we see whether it is a covered tax agreement or not. MLI will enter into force. Say for example, till date, I think 94 jurisdictions have already signed. So for those jurisdiction, MLI has already entered into force. But many more countries are in the process of evaluating MLI, and there may be many more jurisdictions which will sign at a later point of time. So for those jurisdictions, MLI will come into force from the date when they sign it. Then we will see that whether there is a covered tax agreement. As I mentioned that I need to notify and the other country also need to notify me as a covered tax agreement, and then the bilateral DTAA between two countries, between two of us, will become a covered tax agreement. Then we will see that what are the reservations and choice of optional provisions, which are the provisions which have been opted by each of the jurisdiction. And when I am reviewing the treaty with, say for example, Singapore, I will say that what are the reservations which India has taken, or which are the reservations which Singapore has taken, and which are the common provisions which have been implemented and which impact the provisions of the DTAA. Then we go on to the step of notifications of existing provisions, identify which of the existing provisions are modified through these amendments, and then we'll come into entry into effect of MLI. That once both the countries have submitted their instrument of ratification against each other and provided final positions, and whenever we have got into some matched or unmatched, as we have read that whatever is the applicability, then we'll see the impact of those changed provisions on the existing DTAA. So these are the steps of flowchart. Is MLI itself into force? Yes. Then is MLI in force for both contracting jurisdictions to the tax agreement? If no, then MLI does not apply. If yes, we'll see, do both contracting jurisdictions list the agreement in their MLI positions as an agreement to be covered by MLI? That means we are in this third step trying to find out whether this is covered tax agreement or not. Then if it is yes, we will see is the tax agreement in force, means the ratification instruments have been filed and the matching of the provisions or of the opted provisions has been done or not. Then we will say that yes, if that has also been done, then MLI will be applicable, right? Then we move on to step 3. This is only elaboration of these steps which we just discussed, that what are the reservations and choices of optional provisions. Reservations means if either jurisdiction to the covered tax agreement make a reservation on a provision of MLI, the said provision does not apply and does not modify the CTA. Means these are such provisions wherein even if one of the jurisdictions say that I don't want to apply it, then it will not apply vis-a-vis both of the parties. If no, then MLI article could apply and modify the CTA. If there is no reservation which has been prescribed, then there will be automatic implementation of those provisions into the bilateral DTAA. Then there are optional provisions. Optional provisions means that they do not have any automatic implementation. They'll need to be opted for. Say for example, I had mentioned that in terms of, I think, this dependent agent P kind of thing, there have been multiple options which have been provided, that either you can choose from this, either you can mention these paragraphs, or you can mention these 2 paragraphs, or you can mention these 2 paragraphs, means third option of 2 paragraphs. So then we have to opt for it. Now in this option, we have to opt for it, and only then it will apply. Now in that also there are optional provisions which can be either opted by one of the parties, even then they can apply, or there has to be one-on-one matching, only then they can apply. So that is always evident from the language of multilateral instrument itself. So whenever you will be reading multilateral instrument and the provisions which have been notified by India, then you will come to know that which has been the provision changed by the impact of MLI. we have to refer MLI going forward for these 28. Yes, we have to. What are PPT and SLOB? So PPT is principal purpose test and SLOB is simplified limitation of benefits clause. Means principal purpose test, as I mentioned, that what is the purpose of entering into a treaty? As I mentioned that earlier it used to be that fiscal benefits or to avoid double taxation, but now principal purpose test is that I'll come to this example. There is one thing, and SLOB is limitation of benefits, simplified limitation of benefit, that in what circumstances the benefit of treaty will be limited and will not be provided to the residents. So we are not today discussing SLOB because SLOB in itself is a big topic and it needs a lot of interpretation and deliberations. So I have not covered SLOB. I have not covered, in fact, clause by clause interpretation because in itself there are a lot of articles and we'll not be able to cover it in just one session. Right. So the step 4 was notification of existing provisions. So this is what the compatibility clause says, that MLI provision applies in place of existing provision, means that there is an existing provision, but now it will be superseded. Where both the when does it apply? Where both the contracting state jurisdictions have notified the same existing provision, means which provision they want to change, both the contracting state have notified, only then the existing provisions will be replaced. Then the second point says MLI provision applies to or modifies the existing CTA. In this particular case, where both the contracting jurisdictions have notified the same existing provisions, only then it will change. Then if the MLI provision says that it applies in absence of existing CTA provision, means there is a provision in the MLI which recognizes that these provisions are something which are new and which might not have existed in the provisions of existing DTAAs. In those circumstances, when it would apply, where both contracting jurisdictions have notified the absence of an existing provisions, means both the contracting jurisdictions must agree that yes, these provisions were absent and therefore this provision needs to be implemented, and unless both the jurisdictions agree on the absence of this provision, provision will not apply. Then the fourth point says MLI provisions applies in place of or in absence of existing CTA provisions. Now most of the provisions are these provisions only, wherein it types of accommodates every kind of situation, that either there is an existing provision or there is not an existing provision, the provision will apply, but there are conditions where it can apply, where both contracting jurisdictions have notified the same existing provisions, the existing provisions are replaced. In case of notification mismatch, the MLI provision applies and supersedes the existing provisions to the extent of incompatibility, right? So means there is notification, means I have provided something else, I have notified some one provision, and whereas the other contracting state has notified some second provision. So wherever there is incompatibility between the existing provisions and the notified provisions, only to that extent it will apply, and only to the part which I have notified. Say for example, India has notified option A and country B has notified option B. So to that extent which I have notified, and there is mismatch or incompatibility between the provisions of existing DTAA with India and B, only to the extent which I have notified the provisions will apply to my treaty, and the provisions which have been notified by B, and if they are inconsistent with the existing provisions, they will be implemented in respect of B's residents. So when third situation comes in, where neither contracting jurisdiction has notified an existing provision, means none of the contracting states that this will be applicable, the MLI provision applies and supersedes the existing provisions to the extent of incompatibility. Means if the DTAA, existing DTAA is incompatible with the provisions which are provided in the MLI, and neither I have notified, and as we have mentioned that there are certain provisions which are to be applied automatically, those provisions will apply automatically even though none of the parties have notified it. So the stars only says that notification mismatches are cases where one contracting jurisdiction has notified an existing provision but the other has not. or where contracting jurisdictions have made a different notification with respect to existing provisions in the MLI. We have already discussed this. Now, step 4, notifications of the existing provisions. It says that with respect to the taxes withheld at source, as of the latest date on which MLI enters into force, this is which we have already discussed, that from which date the provision will come into effect. So for taxes withheld at source, as of the latest date on which MLI enters into force of each contracting jurisdiction, go to the first day of the next calendar year or financial year. Means calendar year, most of the countries follow calendar year. For India, if it is 1st of April, then we'll go to immediately following next financial year. Then we'll say that MLI provisions in respect to taxes withheld at source will come into effect from that date. As we mentioned that Canada, Denmark, then Ukraine, then there were a few other treaties for which withholding tax provisions come into force from 1st of April 2020 only. But with respect to all other taxes levied by contracting jurisdiction, as of the latest date on which MLI enters into force for each contracting jurisdiction, then we'll have to count 6 months period. We'll have to give 6 months of period for SSCs or taxpayers to implement those, understand those provisions. And then after the expiration of that 6 month period, whatever calendar year or financial year is beginning, from that date, the provisions will come into effect. Right? Now, how the MLI provisions are to be read, this is a very brief overview that what are the kind of modifications which are being envisaged. As I mentioned that India has notified its tax treaties with 93 jurisdictions out of 95 DTAAs which it has entered. So the first part is preventing treaty abuse. So we discussed that Action Plan 6 of BEPS says that we have to tackle treaty abuse, that is an insertion of a new preamble and the principal purpose test. What is the preamble and what is the principal purpose test? We'll just read in subsequent slides. And this is minimum standard. So these two, new preamble and principal purpose test, has to be included in all the CTAs until and unless there is some provision which is already existing and which already covers the intent of these CTA, of these provisions of the articles of MLI. Then PPT is to replace or supersede existing general anti-abuse provisions in CTA. Means if there is only a general anti-abuse provision, then that will be replaced by the new principal purpose test, or to be added in the absence of such provisions. Additionally, India has chosen to apply simplified limitation of benefit clause also, which will generally apply to CTAs if other party has also opted for its application. So now this is something which is for the prevention of treaty abuse, but which applies only if both the contracting jurisdictions has opted for this particular simplified limitation of benefit clause. Only then it will be implemented. Right? I'm not sure. I do not remember which treaty has got this simplified limitation. I think India had opted for simplified limitation of benefit clause to apply for Singapore, but I think Singapore has refused it. But this needs to be seen. But what it means is that limitation of benefit, that there will be certain conditions put on the residents of contracting states, so that they'll have to fulfill those conditions in order to take the benefit of the treaties. So for example, in earlier regime or earlier treaty, there was a condition in India-Singapore treaty that for claiming the benefit of no capital gain tax in India on sale of shares of an Indian company, the Singapore resident company must have incurred an expense of 200,000, means 2 lakh Singapore dollars in the preceding financial year. So that was one of the kind of limitation of benefit clause, an example of that. So now there is a simplified limitation of benefit clause which is more elaborate in its terms and which can be implemented only when both the countries agree to it. Then there is a widening of permanent establishment scope, which talks about broader agency P rule, which we had already discussed in detail in the session related to P. Then there is specific activity exemptions and anti-fragmentation principle. Anti-fragmentation means you cannot just divide many activities between related parties. As I mentioned, in construction P, 3 or 4 companies can divide multiple activities and say that none of the entities is fulfilling the threshold of threshold limit for existence in the source country. So that is what is anti-fragmentation rules, right? Or specific activity exemptions. Say we have read that there are certain exclusions which are related to preparatory and auxiliary services being rendered by the P in India or office or branch in India. So what used to happen is that they will open up different branches doing different activities. Each of the branch, if independently seen, would be indulged in preparatory and auxiliary services. But when we will see that combined activity of all those branches of the Ps, we will come to see that the combined activity is kind of forming a very core activity of the business of the foreign enterprise. In those circumstances, they say that specific activity exemption needs to be seen together and to be seen that whether combined force of these activities can be said to be PE or not, can be said to be preparatory and auxiliary in nature. Only then they will qualify for exemption and not otherwise. Then we come on to addressing avoidance of PE formation by splitting up of contracts. So that means they just artificially split up the contracts and say that because each entity is doing different activities, we do not get covered by the PE clause. That is also tried to be addressed by multilateral instrument. Then there is MAP requests, mandatory binding arbitrations. Arbitration has always been negated by India. They have not agreed for it. In most of the treaties, they have not covered it. But they have always agreed for the mutual agreement procedure. So mutual agreement procedures have been made robust. And they are saying that yes, tax authorities between themselves can do the negotiation regarding the tax clauses, but not a third party arbitrator. They cannot come and negotiate, or they cannot rule on the sovereign tax laws made by Indian government. Then there are certain other key modification which talks about tiebreaker test in case of dual residency of persons. Then rights of taxation of capital gain by source jurisdictions from alienation of shares or interest deriving value principally from immovable property. So these are also some of the key modifications which are covered by the tax covered tax agreements. Now moving on to what is synthesized text. Synthesized text is a kind of superimposed text of MLI brought into the provisions of Double Taxation Avoidance Agreement, so as to make it more simpler for the taxpayers to understand the provisions and understand the impact of MLI on the existing DTAA. Now in respect of synthesized text, it is something which is not necessary or mandatory for the governments or the jurisdictions to make. It is only for facilitation or simpler understanding of the taxpayers, but generally OECD has provided that they have provided guidance that how to make synthesized text, and it has to be only for facilitation of interpretation and application of tax agreements. Guidance also suggests that suggested approach for development of synthesized text. So what are the key principles or the key recommendations of OECD in reference to synthesized text? First is, what are the key principles? Parties to MLI have no legal obligation to develop synthesized text. Means OECD is saying that you can make it, but you are not legally obliged to make. It is for the taxpayers to read the treaty, the existing DTAA, with the text of the MLI, with the ratification instrument which has been filed, and they have to combine all these three and then see what is the impact. So they have left it to the taxpayer that they need to be responsible for their own conduct and to interpret the tax laws. However, where jurisdictions decide to produce synthesized text, OECD encourages them to consult each other in order to ensure a consistent interpretation and application of MLI provisions. So means it should not happen that India just reads the ratification instruments and reads it in its own sense and prepares a synthesized text and publishes it in its own jurisdiction, which may not be inconsistent with the understanding of the other contracting jurisdictions. So they need to consult, and in consultation they need to prepare a synthesized text. Now, there is no official format to develop synthesized text under MLI. However, the OECD encourages that a consistent approach will help all persons, all stakeholders to understand these synthesized text better. I have covered one of the sample synthesized text in my subsequent slides, which will give you a fair idea as to how these synthesized text look like. Then synthesized text to also include explanatory information in form of a disclaimer. And what is that disclaimer? Disclaimer is in this form that before the text of CTA, disclaimer based on general sample disclaimer text should be included. It must say that synthesized text has no legal value. The latest positions, there may be some changes at a later point of time, because as I mentioned, that MLI is a flexible document. So at this point of time, certain country has said that yes, we want to implement this agreement, this provision of MLI, but at a later point of time they may retract it. So once they have retracted it, the provision may go back again. So there is no renegotiation required. It's just the ratification instrument they need to file, and it might change. Then OECD also recommends that you must give a disclaimer that further modifications could be made to MLI position, and these modifications could change the impact. Then the disclaimer in respect of the entry into effect. They say that entry into effect, you must also give disclaimers as to when the MLI will get into effect. You should mention the dates, but you should also refer to the source documents where the MLI provisions are mentioned in the OECD website, and the taxpayers should be encouraged to refer to the original documents rather than just merely relying on the synthesized text. Now moving on to the sample agreement, I have taken India-Australia DTAA, and you will find this synthesized text on the income tax website itself. So whenever you go to the DTAA tab of income tax website, Income Tax India, you will find all the list of DTAAs there. So wherever India has already produced a synthesized text, you will find that listed again on that tab itself. Say for example, if you choose Australia, you will find two links. One is the original existing DTAA, the link for that DTAA, and the second link will be for the synthesized text. So synthesized text is generally a PDF kind of a document which superimposes the text. Say for example, in this paragraph, in this box, the new provisions are generally referred in this box. So what is this? The extract of disclaimer. So there was disclaimer I mentioned that OECD recommends that you must mention disclaimers. So what is the disclaimer as regards to the legal implications or legal reliability of this document? The sole purpose of this document is to facilitate the understanding of application of MLI to the agreement, and it does not constitute a source of law. The authentic legal text of the agreement and the MLI take precedence and remain the legal texts applicable. So say for example, if government does some mistake in reproducing the text of MLI into this synthesized text, and we peruse the text which is mentioned in the synthesized text, which is not exactly the same as was mentioned in the MLI, then the taxpayer will be liable to, suffer at the end, because they have disclaimed that, boss, we are just providing it for your facility. You need to go to the original documents. Changes to the text of the provisions of MLI have been made to conform the terminology used in MLI to the terminology used in the agreement, right? So we have just made these provisions to conform to the terminologies. Then it says that the text of MLI can be found at the following link. So these links are provided. These are two links. So for example, if you would see that one link is this www.org, and then the other link is just below this, that the text of agreement and the protocol, which says that original treaty can be found at this page, right? So they also talk about original treaty, which I've also mentioned here. You can just click on this and it will take you to the treaty pages of the Income Tax India website. Then the next box of India-Australia DTAA talks about entry into force, that when it will be considered to be entered into force. They provide detailed dates that entry into force of MLI. They also said that 25 June 2019, India submitted its ratification, and on 26th of September 2018, Australia submitted it, the deposit of instruments for ratification. Entry into force of MLI 1st of October 2019 for India and 1st of January 2019 for Australia. Now, because Indian financial year does not start on 1st of October, it will automatically apply from 1st of April 2020. Right? So there are other dates which are given here. So you can read it and you can see that from which date which provision needs to apply. For this treaty, the withholding tax provision as well as the other tax provisions will come into force on 1st of April 2020. In the C clause, you can see with respect to all other taxes levied by each contracting state for taxes levied with respect to taxable periods beginning on or after 1st April 2020. Right? For Australia, it was mentioned as 1st January, and withheld at source on amounts paid to credited to non-residents where the event giving rise to such taxes occurs on. So you can read this. Then this is the basic minimum standard which we were talking about, Article 6. This is the exact paragraph mentioned in Article 6 of MLI, which says that what is the intent of entering into this, which is the preamble, right? Preamble of the treaty. Now, there may be an existing preamble or there may not be an existing preamble. Say, for example, the existing preamble of India-Australia DTAA was desiring to conclude an agreement for the avoidance of double taxation and prevention of fiscal evasion with respect to the taxes on income. Now, it says that following paragraph 1 of Article 6 of MLI is included in the paragraph. Included means that it is not superseding. The earlier line also remains, and this will also become part of the DTAA. What does it say? Intending to eliminate double taxation with respect to the taxes covered by the agreement without creating opportunities for non-taxation, right? So probably it is much more broader than prevention of fiscal evasion. They are saying that we will not even allow creating opportunities for non-taxation or reduced taxation through tax evasion or avoidance, including through treaty shopping arrangements aimed at obtaining reliefs provided in the agreement for indirect benefits of the residents of third jurisdictions. Means they will also not allow any resident of third jurisdiction to incorporate a company or to set up a business office in one of these two jurisdictions so as to avail the beneficial provisions of this DTAA. So as you can see that this preamble is much more wider in its intent, and it kinds of cover a broad perspective of tax evasion or tax avoidance through various kind of means which can be there and which the consultants were using in the past. So this is one of the minimum standards, right? Now there is also a change in residence clause. What does it say? That if you would see that this is the existing provision, whereas the provision in box is the changed provision. What does the changed provision say? The following paragraph 1 of Article 4 and subparagraph of paragraph 3 of Article 4 of the MLI. Now Article 4 means Article 4 of MLI replace paragraph 3 of Article 3. Now what it mean is that this paragraph 3 is now redundant. We need not read this. We'll only read this because it says replace paragraph 3 of Article 4 of this agreement. What does it say? Where by reason of provisions of agreement a person other than individual is resident of both contracting states, the competent authorities of contracting states shall endeavor to determine by mutual agreement the contracting state of which such person shall be deemed to be resident for purposes of this agreement having regard to its place of effective management, the place where it is incorporated or otherwise, and any other relevant factors. In absence of such agreement, such person shall not be entitled to relief or exemption. So what does it mean? That in terms of artificial juridical person, the tiebreaker rule generally used to prescribe that it shall be deemed to be solely resident of the contracting state in which place of effective management is situated. Now, how it used to be determined that where place of effective management is situated, there was no provision. Country A could have said that yes, the place of effective management is with me. Country B can also say that place of effective management is with me. There was no kind of procedure to determine that where it is finally placed. Now the amended paragraph says that it will only be determined by the mutual agreement procedure between the two countries, and the competent authorities of the two countries will have to sit together to determine where the place of effective management of the particular artificial juridical person exists. And if there is no agreement between the tax authorities, then the person will not be considered as a resident of either of the state and will not be entitled to the benefit of the treaty. So you can see that how they are preventing the benefits which are to be granted to such kind of persons who are in a limbo kind of a situation, that they are neither there, or they're here also and there also. So these kind of entities they want to prevent, and they want to say that boss, you make it yourself clear that where you want to be considered as resident, right? So going to paragraph 5 in permanent establishment. So as you would see that the changed text is provided in paragraph in this box. It says following paragraph 1 of article 14 of MLI applies and supersedes the provisions of this agreement, which says that applies and supersedes. It means that neither it is replacing, but it is applying and superseding. If there is any contradictory provision which is there in the treaty, this provision in the box will supersede the provision. So either it is not replacing something, but it is kind of an additional text which has been provided in the treaty and which will supersede the contrary provisions which are already existing in the text of the DTAA. Now this talks about what? It talks about for the sole purpose of determining whether period referred to in subparagraph K or paragraph 2 of article 5 of the agreement. Now of the agreement means this agreement, means K, building site, construction, installation, and assembly project project. In terms of determining the period referred to in this thing, means 6 months period which is referred here has been exceeded, where means we will consider the threshold to be exceeded if where an enterprise of a contracting state carries on activity in the other contracting state at a place that constitute building site this identified this paragraph this, or carries on supervisory activities of such place, and these activities are carried on during one or more period of time that in aggregate exceeds 30 days without exceeding the period referred to in subparagraph K of paragraph 2 of article 5, means they have lowered the threshold to 30 days only, right? Then the second clause says where connected activities are carried on in the other contracting states. Please read connected activities, right? Connected activities are carried on in that other contracting state, or where subparagraph K of paragraph 2 of article 5 applies to supervisory activities in connection with same building site, construction, project, installation, this during different periods of time, each exceeding 30 days by one or more enterprises closely related to the first mentioned enterprise, right? Now it says that different periods exceeding time, each exceeding 30 days by one or more enterprise closely related to the first mentioned enterprise. The different periods of time shall be added to the aggregate period of time during which first mentioned enterprise has carried on the activities. So as I mentioned that these are for evasion, for prevention of evasion of treaty abuse, right? So you cannot just segregate the activities between multiple enterprises and say that we have not each individually met the threshold and therefore provision should not apply. Now there are other provisions in this permanent establishment. It says that MLI modifies the paragraph 4. Now here it is only modifying paragraph 4, which says that notwithstanding article 5 of the agreement, means the existing agreement, the term PE shall be deemed not to include. Now they have mentioned these clauses. I think these are same. Provided that such activity, the overall activity of fixed place of business is of preparatory and auxiliary nature. Now overall activity was never mentioned before. So it means to say that we have to see the activities being carried out in the source state as a whole and not in isolation for each of the PEs. It also says that following paragraph 4 of article 13 of MLI applies to paragraph 4 of article 5 of this agreement as modified by paragraph 2 of article 13. Right? Now paragraph 4 of article 5 modified by this, it means says shall not apply to a fixed place of business that is used or maintained by enterprise if same enterprise or closely related enterprise carries on business activities at the same place or another place in contracting state. Means they are saying that these are exclusions provided. Now these exclusions will not be applicable. The paragraph 4 shall not apply. Paragraph 4 shall not apply if the place of business is used or maintained by enterprise, if same enterprise or a closely related enterprise carries on business activity at the same place or another place. Means if the multiple foreign enterprise having multiple places of business in the source country are doing certain combined activity which cannot be considered as preparatory and auxiliary, this provision shall not apply. And the places constitute PE for enterprise, closely related enterprise under the provisions of article 4 or 5 of this agreement, or the overall activity resulting from the combination of activities. Just as I had mentioned, the overall activity resulting from combination of activities carried on by the two enterprises at the same place or by the same enterprises or closely related enterprise at two places is not of preparatory or auxiliary character. So means to say that the provisions are being enhanced so as to prevent treaty abuse. Moving on, there is also this paragraph which says this paragraph applies to this agreement. Now this is just application of a new paragraph which says for the purposes of article 5 of agreement, a person is closely related to enterprise if. Now it says definition of a person closely related to, because now we have seen in previous paragraphs that the term closely related enterprise has been mentioned. Now it needs to be defined. So how it has been defined? By adding a new provision in the article 5. Closely related enterprise if based on all relevant facts and circumstances one has control of the other or both are under control of the same persons of the enterprise. In any case, a person shall be considered to be closely related to an enterprise if persons directly or indirectly hold more than 50% of the beneficial interest or voting power, right? 50% of aggregate vote and value of company's share or beneficial equity. So this is how control has been defined, or closely related enterprises has been defined by adding a new provision. And from where does it provision comes? From paragraph 1 of article 15 of the MLI. Moving on to alienation of property. This is in respect of alienation of property. There also you have seen this box. It shows that what is the changed provision. Then there is a provision for mutual agreement procedure, which also talks about competent authorities of contracting state shall endeavor to resolve mutual agreement, any difficulties, doubts arising as to interpretation of application of the agreement. They may also consult together for elimination of double taxation in cases not provided for the agreement. So earlier the scope of mutual agreement procedures used to be very restricted, wherein only when a notice has been issued by tax authorities, only then the mutual agreement procedures could be initiated. But now the scope has been made much more broader, and any kind of double taxation or to avoid any difficulties, mutual agreement procedure can be initiated. Now, this is also the last thing, the principal purpose test, which was also one of the minimum standards, and this is in itself added to the treaty as an independent provision, which talks about notwithstanding any provisions of the agreement, the benefit under the agreement shall not be granted in respect of an item of income if it is reasonable to conclude, see the wordings, reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purposes. Now please see that obtaining benefits was one of the principal purpose. This is even much more stringent than the local GAR provisions of the Indian income tax law, wherein in the GAR provision it says that the main purpose was to obtain benefit of the treaty. So here there is discussions going on that how to interpret this principal purpose test, because this is one of the minimum standards, and whether it is more stringent as compared to the GAR provisions of the Indian domestic tax law. It says that obtaining notwithstanding provisions of benefit under this agreement shall not be granted if it is reasonable to conclude that obtaining tax benefit was one of the principal purposes of any arrangement or transaction that resulted directly or indirectly in that benefit, unless it is established that granting that benefit in these circumstances would be in accordance with the object and the purpose of relevant purpose of the agreement. So the onus of proving this has been put upon the taxpayers rather on the tax authorities. So the onus has shifted that you need to prove that the benefit would have been provided under the agreement under normal circumstances. So that is how principal purpose test has been incorporated in all the treaties, all the covered tax agreements. So this is one of the minimum standards. So that is it from my side as on date. Today we have already surpassed our intended time close of 5:30.
Yeah,
But
thank you, Ashwin.
there was one question I think from Manish Joshi.
Yes, we can take this.
An interesting question on applicability of PPT is on its impact on capital gains exemption under the India-Singapore Treaty, according to which shares of Indian company acquired prior to 1st April 2017 are grandfathered, while the treaty permits source-based taxation in India for shares acquired on or after 1st April 2017. Can PPT with non-obstante clause override even grandfathered benefits? So that is what the controversy is, and on the plain reading of the provision it seems so that yes, if the relevant circumstances are not proved by the taxpayers, the income tax authorities may challenge the benefits which can be availed in the treaty. So that is something which we need to see, and as this is a very new provision, there is no judicial precedent available. However, from and also probably because this is not a provision, this is not a beneficial provision of the treaty, that this is the intent of the treaty. So probably an argument which we can say that GAR is more beneficial than the principal purpose test, that may not be very much very much applicable in this particular case, and how judiciary is going to review this is going to be interesting to see. And as we are suggesting our clients that if there is a Singapore company which is a now covered tax agreement, they must prepare full and lengthy documentation so as to prove their reasonability, or to prove that the company incorporated in Singapore was not that one of the main purpose was not to obtain tax benefits, right? So
Yeah,
that is
but
something
that is
which we need to do.
But that is prior to this September April 17. So this MLI provisions are coming into effect from this April 2020. So,
Sir, but
so anyway,
sale of shares will be happening at a later point of time now.
yeah.
So the capital gain will apply to the sale of shares, not to the incorporation of the company or not to the acquisition of the shares of Indian company prior to this date. So in a sense, the application is still prospective. We are not saying that it becomes retrospective in its effect.
Okay.
Right? Because
but it is mentioned about acquired prior to April. So whether sale will also.
So that was the earlier text. No? So now the principal purpose test says that if your transaction was happening just because of your transaction is structured in a way wherein one of the main purpose was to obtain tax benefit, then the treaty benefit will not apply. Then it supersedes everything.
So sale happen after press. Okay, 20 then.
Yes.
No.
Right.
Okay.
So it says, notwithstanding any provisions of the agreement, the benefit under agreement shall not be granted in respect of item of an income. Now, when is the item of income arising? It will be arising now, today, when the sale of shares happen.
Yes, right.
Right, Manishji?
Yes.
So
I think thanks everyone. Thanks for your patient listening. I was on a very fast speed today because it is such a big topic and I had to cover a lot of things. And thank you everyone for taking out your time on weekends for joining this web series on international taxation. And I hope that you have enjoyed it. I will be requesting you all to give some feedback. I will be making some posts on LinkedIn or somewhere, probably I'll share it with you guys. And I will be very happy if you share your thoughts on the web series, the content, the whatever you have gained out of this series. It will be very helpful for us. And if you have also any suggestions for improvement, please feel free to give those suggestions, because ultimately that's how we will improve the content as well as the benefits which can be given to the participants. Piyush ji, over to you.
yeah, Anshul, thank you so much. And you have presented a very good presentation in all these series. And we have a lot of speakers who are well versed with international practice. And we have covered some basics, like basics of DTA, Article 1 to 25, and Protocol to DTA, MFN clause, and EOI, and impact of multilateral instruments, and various concepts we have covered in these 12 web series, and hope you people all enjoy also. And I just want to thank everybody, CA Sonal Arora, CA Nitin Goyal, CA Amrish Chaudhary, and Advocate Manoneet Dalal, and Gaurav Gupta, Ashish Agarwal, Sharad Goyal, and the great initiative done by you and Vijayji. Thank you so much. And we need your feedback in WhatsApp group, and you can share your feedback, and hope you are all receiving our emails with PPT and recording. So thank you all.
It was wonderful from our side. We enjoyed as much as.
And we have next session on career growth for CA by NIRC 6 to 8. So you all can join. We have shared link in WhatsApp group. So it will be, we will have speakers from Canada, Kenya, and Singapore and Australia. So you can join.
Sure, Piyush ji. Thanks a lot.
Yeah. Thank you, Anand. Thank you, Anshul. Thank you, everyone.
Thank you, everybody.
Bye-bye.
Bye.
Bye, everyone.
Thank you.
Thank you, Manshu.